Welcome to today's Explainer. We're jumping right into the core of how to build and protect your long-term wealth without getting totally wiped out by market volatility. Building wealth is about way more than just throwing capital at financial markets and hoping for the best. It's really about architectural resilience. So today, we're unpacking the exact strategies that ensure your financial structure can weather literally any economic storm. Let's get right into it.
Take a quick second to think about your own setup. Are all your investments kind of clustered in one single area? Because if you're concentrating all your capital into just one investment or even one specific industry, you are taking on a massively higher level of risk. Sure, a concentrated portfolio might pump out incredible returns when the stars align, but man, if the tide turns, your entire net worth takes a direct, unmitigated hit. The real secret to long-term success? It isn't about avoiding risk altogether, it's about managing it strategically.
Okay, here is our blueprint for this explainer. First, the core of risk diversification. 2. 3 dimensions of diversification. 3. Strategic asset allocation. 4. Technology and portfolio management. And finally, mastering behavioral discipline.
Starting off with Section 1, the core of risk diversification. Look, we all know the old saying about not putting all your eggs in one basket. But at an institutional level, it's really a hunt for non-correlated assets. The true magic happens when you find assets that move completely independently of one another. Basically, when one zigs, the other zags. By intentionally combining assets that have totally different performance patterns, you mathematically crush the probability of a single economic event just devastating your entire portfolio.
Moving on to Section 2, 3 dimensions of diversification.
The very first dimension here is asset class. You're probably familiar with the classic tug-of-war between equities and fixed income, but instead of looking at them as competitors, you've got to think of them as counterweights. When equities go through those crazy high-velocity downturns, it's the fixed income securities like government and corporate bonds that step up to anchor the portfolio. They provide that absolute, much-needed structural stability. Next up is sector and industry. It is just fascinating how different economic weather impacts different industries. I mean, healthcare needs don't just magically pause because there's a recession, right? Meanwhile, tech thrives on rapid innovation cycles. Consumer goods hold steady because of everyday demand, and financial institutions generally ride the wave of economic expansion. So by spreading your capital across these diverse sectors, you capture broad economic growth while totally insulating yourself from a sudden collapse in any one specific area. And the third dimension is geographic. Did you know that some of the absolute best performing years in emerging markets line up perfectly with completely flat years in developed ones? That's why global diversification is absolutely critical. By blending the established stability of developed markets, like the US, Europe, and Japan, with the massive high-growth potential of emerging markets in places like Asia, Latin America, or Africa, you completely remove your dependence on a single national economy. Plus, going global gives you built-in currency diversification, which is just a phenomenal extra layer of risk management.
All right, Section 3, Strategic Asset Allocation.
So when we actually map out strategic allocation, a classic balanced distribution might look something like this: 40% in equities, 30% in fixed income, 15% in real estate, 10% in commodities like gold or oil, which are great inflation hedges, and then a 5% slice in alternatives. This kind of balanced setup beautifully marries growth engines with defensive assets. And honestly, it proves that smart allocation is all about building a resilient long-term structure, not just trying to guess short-term market moves.
But here's the catch. Setting those percentages is definitely not a set-it-and-forget-it situation. Think of it like tuning a high-performance engine. If a massive bull market inflates your equities from 40% up to 60%, suddenly your risk profile is way out of whack. That is exactly why periodic rebalancing is so vital. It basically forces you to trim your winners and buy the underdogs, making sure your allocations stay perfectly aligned with your strategic targets as the market evolves.
Let's slide into Section 4, Technology and Portfolio Management.
What completely blows my mind these days is how deeply tech has transformed this entire space. First off, artificial intelligence can instantly spot these hidden asset correlations that a human analyst would almost certainly miss. Then you've got predictive modeling, which literally lets you stress test your portfolio against simulated market crashes and totally different economic scenarios. And to top it all off, automated systems handle that crucial portfolio rebalancing we just talked about completely on autopilot. It's a total game changer.
Which brings us to our final part, Section 5, Mastering Behavioral Discipline.
Because ultimately, you know what the biggest risk to a brilliant financial structure is? It's us. Human psychology is a total trap. During market rallies, greed tempts us to concentrate our money into whatever asset happens to be skyrocketing, which massively spikes our exposure to a crash. And then, when the market inevitably takes a dip, fear kicks in, pushing us to prematurely sell off the exact diversified assets we put in place to protect us in the first place.
So how do we actually fight back against our own brains? We stay the course. To genuinely protect your wealth for the long haul, you absolutely have to maintain behavioral discipline. You have to rely on your structured strategy instead of reacting to the daily panic of the market. Doing regular, scheduled portfolio reviews is the best way to ensure your setup stays aligned with your actual goals, so you don't just cave to those short-term emotional impulses.
So, after saying how all these distinct pieces fit together, I want to leave you with one final thought to chew on. Is your portfolio truly ready for tomorrow's market? Take a hard look at how your wealth is structured today. Ask yourself honestly, is it just built to ride the easy waves, or is it actually built to withstand the storm? Thanks for hanging out with me for this explainer. I really hope this empowers you to take a much more structured, resilient approach to your financial future.